Ho, ho, ho. Hey guys, it is really good to be back. I have missed being with all of the dividend investing crowd, so I'm glad to be back with you guys. I hope you had a wonderful Christmas and that Santa was very good to you. Maybe he brought you some Hershey stock. If he did, let me know in the comments. Or if maybe he just gave you some cash that you can translate into some Hershey stock. That would be a good thing. So yeah, I'm glad to see you guys. We've had a lot of people here over the holidays, and most of them left today. So I am. It's kind of glad, or I'm kind of glad that we have a quiet home again. So it is. It was pretty rough and rugged around here for a few days. We had a lot of kids here, and I love being around kids, but it's difficult to do a live stream when you got a 2-year-old running around. So just happy to be here tonight, and we've got an interesting topic tonight. I think it's an important topic, and I think it's something that I needed to actually go through again. And so I thought, oh man, if I needed to go through this, maybe it would be helpful for you guys as well. So I'm gonna go ahead and start in this presentation. But as I go through, if you guys would let me know in the comments if you guys have identified any dividend yield traps out there. And we're going to talk about that a little bit. But if you have any just off the top of your head that are yield traps, certainly let me know. So let's go ahead and get started on this. I'm going to pull up, not having done this for a while, it's kind of hard to get back into the swing, but I am going to do my best. And oh wow, look at that. I do have this screen up. So today what we're going to talk about is we're going to talk about dividend yield or total return, which is better. So a lot of times as dividend investors, we want to focus on those dividends. We love those dividends coming in because we can use those to either drip back into the stocks that they came from, or take those dividends and buy shares of other companies. And it really is a way to keep us engaged and keep things moving in our portfolio. And for guys like me who have retired, it's I've got a third option, which is to actually pull it out and use it for expenses. So should I look at dividend yield or should I look at total return? So let's see which one's better. The next slide here is what is dividend yield? So dividend yield is you get the dividend yield by taking the annual dividend and divide it by the current stock price. So this would, and sometimes you'll see it as the forward dividend yield, and that's basically what they believe the company will pay out based on its projections for the next year, the next 12 months. Divided by the current stock price. That gives you a yield, and that yield is basically the percentage. It's almost like an interest rate percentage, that for every dollar you would invest in this particular stock, you would get X percent back in dividends. So that's an important metric to have. But the second one is total return. Total return, and you'll see this on the bottom of the slide here. Total return includes interest, capital gains, and yes, dividends, as well as distributions realized over a period. So total return doesn't just look at dividends. It looks at the interest, you've gotten, if you've got a money market account, that would factor into total returns. Capital gains. So if the stock price was 50 when you bought it and it's 100 now, then that $50 is capital gains. So you would take capital gains, dividends, add them together, and any other kind of stock dividends or any other distributions that the company did, you would add all of that together to get your total return. So total return is really everything that comes into play with the stock. So now let's move forward. We're going to look at VOO. VOO is the Vanguard S&P 500 ETF. And I put a chart here so that you could see the growth of $10,000 in VOO. And I think this was, it's like a 13-year period, or no, it's a 10-year period. Started in 2013 to 2023. You can see that the price of VU appreciated, by some number, which is a lot. It says it would go to 41,000. So that's like 411% that it grew from 2013 to 2023. So that, my friends, is the capital gain. That is the share price movement of VU. And you see over here to the right, I've added the dividend yield, which is 1.45%. So not only did VU pay 1.45% in dividend yield, it also has given a pretty sizable return over the 10-year period in capital gains. And so if I look at the total return, and this data, the growth here of 10,000, as well as the total return percentages, is provided by Morningstar. The dividend yield comes from Simply Safe Dividends. So you can see that, let's look at the 3 and 5 year. You can see a 3-year total return of 10.58% per year, and a 5-year at 15.88% per year. That's a pretty nice total return. But again, the dividend is somewhere in the 1.5% range. So I want to make sure that we understand that the dividend yield is only the dividend. The total return includes everything about the stock. So hopefully that's a good example. Everybody's favorite ETF is SCHD. I thought I would put that in here as well. You see it grew over that 10-year period to 37.9, which I think would be about 379% off of $10,000. And then its dividend yield, though, is 3.48%. So, it's been nice to get a dividend from them. That's a pretty sizable dividend, but also getting some nice gains on the stock price. You can see the total return, though, in the 3-year is 9.78. The 5-year is 14.17. Let's flip back and compare that to VU. We were at 10.58 versus 15.88. So VU was a better performer, but not significantly. So over that 3 and 5 year period, those two ETFs on a total return perspective performed very, very well. So now let's move forward and talk about, is yield or total return more important? And I will tell you that my preference is to focus more on total return. And so you might ask, why is that? And a couple of reasons. One is that yield is only one measure of return for an investment. We're investors. As dividend growth investors, one of the words that we use is investor. So we are actually an investor, not only in a stock. We don't buy a stock and hope it goes up. We research the company and buy a share of the company, a wedge of the company. And therefore, we are investing in a company. So we're not just looking for the yield. We're looking for a total return. The second thing is that focusing just on yield, and this is kind of a warning, focusing just on the yield can lead to yield traps. Now, yield traps are really horrible things. And so I wanted to spend a little bit of time on those. So let's kick that off. What is a yield trap? A yield trap is a stock where the dividend yield is just too good to be true. And we've all seen those. How do we identify a yield trap? Well, we use concepts that we've learned in the prior live streams. And remember, this is really about education as much as it is about getting together. So, we've learned about ROIC, return on invested capital. We've learned about payout ratios, both earnings and cash flow. We've learned about the dividend CAGR, the 5-year dividend CAGR, the cumulative average or cumulative annual growth rate, the interest coverage ratios, what we call the ICR. So those are factors. Those are things in our due diligence that we look for to help us identify that the business is growing well and that we are not getting sucked in to a yield trap. So let's go a little bit further. Let's look at, I picked two, let me flip over to my portfolio here. And I'm going to shift this to present. Sorry about this, guys, but I'm shifting gears here really quick because I want to go into my portfolio here, and you can see this is Simply Safe Dividends up here in the corner. But my portfolio is in here. I have 35 holdings currently. 3 of those are ETFs, so I have 32 individual stocks. But I wanted to show you, I have a dividend yield here. I'm going to sort this in descending dividend yield order. So you can see my top 2 dividend yields are Altria Group, which is ticker symbol MO, trading at a dividend yield of 9.76%. And again, that's taking the annual dividend divided by the current stock price. Hess Midstream, ticker symbol HESM, is 7.8%. So I thought what might be kind of fun is to actually look at my top 2 highest yielding dividend stocks and taking a look at those and seeing if we think those are yield traps or not. Then I've got another stock or 2 that we can look at that I think are actually dividend yield traps. So let's go to, let's first of all flip over to Microsoft, and I think you can see that. So this is Altria Group. Let's take a look at MO here is in the blue. Hopefully you can see that, and the bar chart here shows the returns, but just the numbers I think are important. So in 1 year, it's minus 5%. In 3 year, it's 7.08. 5 year is 3.52, and 10 year is 6.21. So, we look at the dividend yield and we ask ourselves, wow, at what did we say it was? It was 9.76% dividend yield. The total return over a 10-year period is only 6.21% per year. So basically the stock has been deteriorating, the stock price has been deteriorating over that period because we should be getting at least 9.76%, right? If we're getting any capital appreciation at all. But let's flip over now because there's another important point that we need to look at to determine whether a stock is a yield trap. And I think what we're going to look at to maybe show this the clearest is fast graphs. And you can see this is Altria Group from, 2002 maybe, all the way to the present plus the next few years of projections. So take a look at this, guys. This orange line represents the earnings of the company at a 15 PE. So the PE, the price earnings ratio, doesn't change. So in essence, that is the line that would show where the earnings of the company is. So any change in that line is related to company earnings, not from any kind of PE change. So it's fair to say that the orange line shows that the business of Altria Group is actually improving over time. It has gone from, down here, which is, it had a price of 15.87 at a 15 PE. Now it should be at $74.25 with a 15 PE. We could argue whether 15 PE is appropriate for Altria, but the point is that this orange line represents the fact that Altria's earnings are getting better. So the business, even though, Altria is about cigarettes, and there's a whole bit of, regulation and all of that comes along with this. And I think that's what's impacting the stock price. But the business itself is actually improving. At least earnings are improving. So I think that's important to see. And then let's go over to Simply Safe Dividends again. Let's look at Philip Morris. So let's look at, I always get confused about that because their ticker symbol is MO. So I always want to call them Philip Morris, but it's Altria Group. Let's take a look at, they have a little wavy line here because they went through a divestiture. They actually divested off Philip Morris and I think Kraft Heinz back in this time frame. And so it just looks weird. So we won't even stop there. Let's go down to look at some of the ratios. The earnings payout ratio, yeah, it's a little higher than what we typically think about, but for tobacco companies, it's actually, in a pretty decent spot, both the free cash flow as well as the earnings. But here's some really cool stuff. Let's take a look at revenues. Where are they at? Revenues are actually been kind of flat over the last couple of years. But look at this return on invested capital, 51% over the last 12 months. That's dramatic. Their net debt to capital is 0. Their interest coverage ratio is almost 11. So the business itself, the point is, the business itself is actually doing very well. So I don't find Altria Group to be a yield trap. They can absolutely support the dividend. It's other factors that are causing the stock price to be low, driving the yield higher. So let's look at another one of mine, which is Hess Midstream, ticker symbol HESM. That's the second highest dividend yield that I have. So I'm just putting my portfolio to the test because, why else would we do this if we weren't willing to look at our own stuff, right? So Hess Midstream started around 2016. It is what we would call an MLP, a master limited partnership, but it doesn't trade like one. It actually issues a 1099 rather than a K1. So if you're interested in an MLP type income, but not interested in dealing with the tax consequences of a K1, take a look at Hess Midstream. I own a few shares of it. I don't know, how many shares do I own? Let's look. I own about 700 shares of that. It's about 1.6% of the portfolio and about 4.5% of my income. My yield on cost is pretty high. I started buying this a couple of years ago, so it's about 9.5%, but the current yield is about 7.8%. So let's take a look at some of the business factors. And again, since it's really more of an MLP, they use DCF payout ratio. It's around 62%. Very good for MLPs. Free cash flow payout ratio is phenomenal. Free cash flow per share really high. Let's take a look at some. Look at the sales. The sales just continue to go up. Their shares outstanding are increasing, but there's a reason for that. It's not really important for this discussion. If you want to hear more about why their shares are going up, I'm happy to have a discussion about that. If you want to chat offline or on Instagram or wherever, on the Discord, wherever you want to contact me, happy to have that discussion. Take a look at return on invested capital in the 20s, like 23, 22%. That is pretty good for an MLP. Net debt to capital is rising. And again, it's the same reason their shares are rising. And their interest coverage is 4.67. Typically, I like to see that around 8. But according to Simply Safe Dividends, 2.5 or better is good for MLPs. So Hess is a pretty solid business from my perspective. And so let's look at their fast graphs. I'm going to fast this up a little bit so we don't spend too much time on it. But you can see here that their business also, this orange line would represent how well their business is doing. You can tell that the orange line is getting better. So their business is improving. The stock price, however, is running below, in my opinion, what the business is worth. So I'm currently not buying at these prices. It's currently trading around 31. My average cost on this thing is, let's take a look. Cost per share is about $25.93, so about $26 a share. So when it dips, I do buy more. I believe it's a good, solid, income-producing stock for someone like me who is retired. So it's worth looking into if you haven't looked into it. But again, I don't consider it to be a yield trap. Now let's take a look at AGNC and determine whether we think it is a yield trap. So let's take a look first of all at Simply Safe Dividends. AGNC investment. It's got a dividend safety rating of 23, so we're already kind of getting a clue about that. But if you don't have Simply Safe Dividends, how can you determine it? So first of all, it's got a dividend yield of 14.3%. That's pretty high, almost too good to be true, right? So let's take a look then at some of the ratios first. You can see that their dividends per share continue to decline over time. Their earnings payout ratio actually doesn't look too bad. What's their revenue doing? I don't see revenues. Maybe I passed them. No, they don't show them at all. They have sales growth here. Oh, there it is. Sales. Look at the something's weird. Look at 2022. They got a negative 1.1 billion in sales. So not really sure. I don't invest in AGNC, but I did want to show that I do believe they are a yield trap. Their net debt to capital is really high. They don't have an interest coverage ratio here. But let's take a look at Fast Graphs really quick, and let's pull up AGNC. Let's see how the business is doing. And the business is really not doing well. You can see back in 2010 was probably its best year. And since then, it has come down. It's swelled a little bit over the last couple of years, but is forecasted to continue to erode. So, the price of the business, you could argue that it's undervalued at only 3.4x, at 3.4 PE. So you could argue it's undervalued. And if you were a value investor, you might try to capture that value. But my take on AGNC is that in the long run, this line will continue to decline. And if you were able to capture the difference between the orange line and the black line, it would only be a very short-term thing. So you would have to be on your game there. But so therefore, I believe AGNC to be a yield trap. That's my opinion only. If you own AGNC and have a different opinion, I'd love to chat about that. And I did put Bristol Myers Squibb on here just to ask the question: is Bristol Myers Squibb, BMY, is it a yield trap? So let's take a look. We've got Bristol Myers Squibb. It's got a dividend safety rating of 70. But again, if you don't have Simply Safe Dividends and you see a dividend yield of 4.69, which is really not that high, but let's look at their fast graphs, and I'll show you why I wanted to include them. Because BMY, you take a look at this, BMY's business has gotten significantly better over the past, let's say, 5 or 6 years. But look at their stock price. Their stock price is flat, even down. So if we were to go to Morningstar and look at BMY and a total return, what we would see is, we've got to look at trailing returns. What we would see is that over a 3-year period, it's negative 1.95. A 5-year period is 3.69. 10-year period is 2.59. It is a lower total return than their dividend, which is 4.69. You see that? Their dividend's 4.69, but their total return over a 10-year period averages 2.59% per year. That's worse than Altria. So when you net the two out, it's worse than Altria. So is it a yield trap? I don't think so. I think there has to do, and again, I think it's related to their drug pipeline and things like that. I'm not an expert on Bristol Myers, but look at the way the business has improved, but their price is really low. So, a value investor might take a look at this and go, wow, there is some potential here. But I don't particularly believe that Bristol Myers Squibb is a yield trap. I think it is just suffering from other business factors that's causing the price of their stock to be lower. That's, again, my opinion only. So are these yield traps? I would say Altria, no. Hess Midstream, no. AGNC, yes. Bristol Myers Squibb, no. Those are my takes on it. So what's the key takeaways? Is it better to focus? It is better to focus on total return. Always include a question in your due diligence, and I include the question in mine about yield traps. Am I looking at a yield trap? And if so, why? If not, why? And then invest with a long-term focus. So don't just invest because something's cheap. Invest because it is a cheap business that has huge long-term potential. So those are the key takeaways. I don't think I've got anything else here. No. So anyway, I know it's a bit long-winded, but I think it's really important when we look at stocks to look at stocks and determine whether we're looking at a yield trap, because as dividend growth investors, we are looking for companies who are paying solid dividends. And sometimes we can get sucked in to a company that's paying a really big dividend. So, all right, there's that. Now let's bring you guys into the scene here. Let's see who we got online. We've got Pat. I think I'm going to move this screen up. Sorry, guys. I don't want to be looking down the whole time I'm on this broadcast. I've got a monitor that's actually right up here by the camera, so I can just look my eyes down a little bit and actually see what's on this monitor. So I'm going to put you guys there so that I can be kind of looking at you at the same time. So we've got Pat. Hey, welcome, Pat. I did have a great Christmas. I hope you did too, my friend. And Kenji says, rock and roll. Absolutely, my friend. We finally got online. We've got Michael Swami. Happy holidays to everyone. Pat says, what a great November and December so far. LOL. And we have one trading day left in the year. And the other question I want to ask you guys before we get off here today is, what do you think the last trading day of this year brings? Do you think we're going to be higher, or do you think we're going to be lower? And I will go ahead and spoil, at least for now, maybe they're not out yet, the futures. They are out. The futures for tomorrow are pretty flat. So the futures don't know what we're going to do tomorrow. And so I'm going to ask all you smart people out there, where do you think the market's going tomorrow? Okay. We've got Billy. Hope you and your family had a great Hanukkah. Well, I don't celebrate Hanukkah, but I do know people that do, and I hope all of you had a great Christmas or Hanukkah or whatever it is that you celebrate. And so I'm just happy to be with you guys tonight. We've got Kevin Mendoza in the house. Welcome aboard, Kevin. We got Philip from New Zealand. Philip, it's got to be either really early or really late there for you. So I am just super stoked that you have made the sacrifice to join us. So Michael says Zim. Zim, I agree, is a yield trap. Zim is a shipping company. I think it's based out of Israel, and they issued a dividend that was like a real high yield, and then they chopped the dividend. They cut it out. So absolutely Zim. So Pat says MPW was and still is. So way to go, Pat. I think you're right. I think MPW is. And Michael agrees with that. Pat says he looks hard at both. Yeah, so that's a good thing too. But I guess the point is that don't not look at total return. Don't only look at dividend yield, but look at both. Okay, John J. This is a long one here. Hello, and great subject. Dividend stocks considered value stocks, ? Versus other stocks that pay no dividend, known as growth stocks, expected to give high growth in place. So let me try to break this down a little bit. I think that means, in your opinion, are dividend stocks considered value stocks? And I would say that it can be both. A value stock doesn't necessarily have to be a dividend stock. A value stock is a stock that is trading at a price much lower than its intrinsic value. So if we look at if we're measuring the valuation of a business, we would value its future cash flows. Let's say we're going to use what do they call that? The discounted cash flow method. We're going to look at the future cash flows of the business, discount those back to today, and we're going to say, hey, this is the intrinsic value as I see it. Then we're going to look at the price of the stock on the market. And if that price is a lot lower than that intrinsic value, we would call that a value stock. So it doesn't matter if that stock pays a dividend or doesn't pay a dividend, it can be a value stock. The second question is versus other stocks that pay no dividend. So a stock that doesn't pay a dividend can be considered a growth stock, but it doesn't necessarily get to be called a growth stock if it doesn't pay a dividend. It could be a company that just doesn't pay a dividend, and it could be in trouble, right? So it doesn't necessarily mean that it's a growth stock if it doesn't pay a dividend. But a growth stock would be a company that is growing and is not paying a dividend because it wants to take all of the cash that it has at its disposal and invest in growing the business and growing the business fast. So that to me would be considered a growth stock. So hopefully that's helpful. I think I've addressed all of those little pieces there. If not, shoot me another note and I'll try to do a better job. Dividend growth is very important to me also. Yeah, that's great, Pat. I agree. Yeah, and Kenji, Vanguard is good. I have VU, which in my portfolio, which is the S&P 500 index. And so, yeah, I do like the Vanguard funds. I also like the iShares funds because I actually have two of those. Sorry, I'm getting a little parched. Okay, here we go. VU is Roman numeral 5, yes, and the 00 is the zeros. So VU is S&P 500. You know, I never knew that. So I have learned something tonight, John. I appreciate you sharing that. So VOO in Roman numerals is 500. So it's the S&P 500. That makes total sense now, and it should have been obvious to me, but it was not. So I really appreciate you sharing that. That's good stuff. Oh, Chris is in the house. Kamarai is in the house. What's up, all? He says, I'll take total return now, and when I retire in 15 years, yield. And I think, being in the retirement phase, my friend, you're going to want both in the future as well. So that's just my take on it. Let me know in 15 years what you think. Can we do a lookup on Disney? So, yeah, Disney, I think, has just recently reinstated its dividend. So let me do this. I need to move this screen down here because it was hidden from view. Now I can, oh yeah, I'm back. So let's take a look. I'm gonna share this like that. No, like this. I'm gonna take your thing off the screen there so we can see. So let's take a look at Disney. I mean, they're a popular stock. They've got a great park down in Florida if you've never heard of it. So DIS. You can see that according to Simply Safe Dividends, this is not Simply Safe, according to Fast Graphs, they appear to be a little overvalued. If you believe a 15% or 15 times PE ratio, but obviously they are way down from where they were back in the 2020, 2021 timeframe. So yeah, they look a little bit on the low side. What else do we want to look at there? We want to look at, find my cursor. Let's look at Simply Safe Dividends and see what they say. Okay, their dividend yield is 0.66, and it does say here that I'll raise this or make this a little bigger so you can see it. They have just started paying a dividend, so we can't calculate its growth rate yet. So that's important, and they don't even have them rated. And you can see here how they went from paying a dividend to not paying a dividend and then not reinstating it for at least 2 years. So yeah, once that happened, I did not invest in Disney, but once that happened, I've decided to stay away from Disney and not invest in them. Let's see, their payout ratios wouldn't exist because they've got those time frames without paying a dividend. Sales are going up. That's a good thing. You can see they're going up and to the right here. The return on invested capital, though, take a look at this. 2%, 2%, 4%, 5%. They're not lighting the world on fire in terms of return on invested capital. Their net debt to capital is pretty decent. Interest coverage ratio is pretty low, though, at 4.7. I would want that to be around 8 personally. So, I look at that and I say, I don't know. Let's see what Morningstar has them valued at. That's kind of an important thing. We'll do DIS. Check that out. They're trading around $90 a share. And the fair value, according to Morningstar, is 115. So, if you are interested in Disney, then it seems to be a bit undervalued, according to Morningstar. But it's just not something that I just don't trust them if they're going to cut the dividend and not reinstate it after all that time. Anyway, those are my thoughts. BMY, I think we looked at already. So let's say, I'm new to investing 2 months, but have Mo and BMY. Are they traps? I need schooled. And the answer is I don't believe either one of those are yield traps. I wanted to use those as examples because Philip Morris, Altria Group pays a pretty high dividend. I own that in my own portfolio. So I don't believe it to be a yield trap, and I don't believe Bristol Myers Squibb is a yield trap either. I think it is highly undervalued, though, and I don't know why it has been undervalued for so long. So I don't know why that is. So therefore, I don't invest in it because I just don't understand what's causing it to be undervalued. It could shoot up tomorrow, and if it does, it would be warranted, but I just don't know why. Pat asks, "You're okay with Mo?" And I say yes. I'm okay with Mo. If I were a young investor, I don't know that I would mess with Altria Group. It has got a super high yield, and it works great for my portfolio because as you all know, a portion of my portfolio I invest for income, and so Mo, Altria Group is a great stock for income. For me, I believe it's solid in the near term and in the medium term. Not sure how the long term gets impacted with all of the regulation and things like that. But yeah, I think I'm okay with Altria Group. Just my opinion, though, and it's my portfolio, so I get to choose, right? So it's your portfolio. You get to choose if you have it in there or not. So that's the beauty of all of this. We've got the Cookie Monster is in the house. Welcome, Cookie Monster. Hey, everyone, just checking in, but we'll be catching the replay. Hope everyone had a great Christmas and an upcoming safe new year. Thanks, Cookie Monster. And thanks for dropping by, my friend. That is always good to see you in the live stream. So what do you think about covered call ETFs? That's a great question, and it's probably one that I'm going to have to get a drink before I answer, because this is a sensitive subject. I am not a fan of covered call ETFs. I know a lot of my friends have them, and if you're looking for one that would be an example, it would be JEPI, JEPI. And here's why I'm not a fan. I think, and you can look back, I did a video, gosh, probably been a year and a half ago, regarding options and about the risks related to calls and puts and where the risk falls. And so if I'm buying a call, then I have 100 shares of stock and I'm saying I will sell it to you at a certain price. So I take all of the downside risk of that. So if I own the shares and the shares plummet in price, all of that risk falls onto me because I am the owner of the share. The person who paid me for the option to buy those shares is just out the premium. So they're limited on the downside. I have all the risk on the downside. But by selling that call, I am giving that person the opportunity to have almost all, wherever the strike price is. For those of you who understand options, the strike price, it's where you say that you will sell those shares at. Anything above that strike price is an opportunity for the person who holds the option. So I'm limited on upside when I sell call options, and I bear all of the risk on the downside. I just find that to be a bad model when we are in a bear market, because you never know when that bear market's going to end. And if you're loaded up in covered calls, which these covered call ETFs are, their upside is a bit limited. So if you look back at there was a day a week or so ago, maybe a couple of weeks ago, where the market shot up a lot. I think it was up like 1.6%. Take a look at the performance of JEPI there, because I did, and I don't remember exactly what it was, but I think it went up 0.5%, while the rest of the market went up 1.6%. And that is because it is limited in its up side. So what do I think about covered call ETFs? I think they work great when the markets are going down and there's a big return, because not only are you getting dividends, but you're also getting the premiums from the call options. But man, those the risk of the downside, it's just not a great thing for me. So I don't own any, and so if it's your portfolio, you get to decide. But why do I still have Morningstar up? There we go. Is that better? All right. Not a trap, since earnings per share is $2.95 and dividend yield 60 cents. That must be Bristol Myers. So yeah, I agree with you. I don't think Bristol Myers is a yield trap. I wanted to show it though because of the stock price, and the total return over a 10-year period would make it look like it could potentially be a yield trap. But it is just related. The business is doing fine. It is the stock price that's suffering. So that's the part I wanted to share about Bristol Myers. Yeah, and you said it is Bristol Myers. Let's see. David Clark, welcome, David. It's good to have you. Hello, my friend. Hope you're having a good Christmas season. Pat says green. You think so the market tomorrow is going to be green, so that'll be great. And let's see who else has that same sentiment. Billy says it's going to be higher, so that's good. We got Philip in New Zealand who says that it is going to be higher. David says green, but mostly flat, so maybe just a little green, but on the flat side. 3:30 p.m. Oh, so it's 3:30 p.m. in the afternoon for you. That's a little different than I thought. So 3:30 isn't bad. Actually, it's later here than it is there. So, but I'm glad you're here, my friend. I'm not sure why you're sorry, Billy, but because you said Happy Hanukkah before. Hey, no worries, my friend. Absolutely. All right. Can you look at FMC? That's FMC Manufacturing. Absolutely. For you, Billy, I will do anything. So all you have to do is ask, my friend, and we will take it from here. Let's see if I can get to there we go. All right. Let me flip back to this. We will go to, let's look at Fast Grass first this time, just because we can. FMC Corp. Looks like, wow, their price has plummeted, and so has their business. Take a look at that. So their earnings projections are down. They are forecasting higher, but what company doesn't forecast higher unless there's something really wrong? So most companies you will see forecasting higher, and these dotted line forecasts on Fast Graphs are the forecasts. So their business has dropped off significantly. So let's see. So it looks like they're kind of in the fair value range to me. Let's take a look then at Simply Safe Dividends and see what's going on with them. They're borderline safe at a 60. Current yield is 3.6. Let's look at some of the numbers. Just wow, look at that dividend. They have been growing. They've grown their dividend over the last 5 years by an average of 27% per year. You can see that 2018 to 19 was a huge dividend increase, but they have slowed down and they have grown it by 0%. Let's take a look. They have skipped. You can see that they, at least starting in January 22, they did 4 months at 53 cents. Then they have done 5 months at 58 cents. So, it's not looking, maybe they'll increase it. I'm not really sure. Let's take a look at some of the other numbers. Looks like they, according to Simply Safe, they are at a higher yield than normal and at a higher PE than normal. And I'm sure it has to do with earnings. So something has happened with their earnings. Their earnings payout ratio is rising significantly. It's really been mainly in below 30%. The last 12 months is 46%, and the next 12 months is forecasted to be 60%. So that might be something you want to keep an eye on. I would want to understand. I don't invest in FMC, and I'm not familiar with their business, but I would want to understand what caused their business to drop off. And is it cyclical? Is it seasonal? Is it cyclical? I would want to know that kind of stuff before I invested in them. If I really thought that business would come back, then I might not be too worried about that. Their sales are dropping off. They've dropped back below $5 billion. Their return on invested capital is around 12%, so that's not too terribly bad. Net debt to capital, they've got about half their capital in debt. But take a look at their interest coverage ratio. And again, this is a function of the fact that their earnings are down. So they have gone from 8 to about 4 in interest coverage ratio. Let's take a look at Morningstar and see what their value is according to Morningstar. According to Morningstar, they are valued at 110. Wow. So Morningstar is believing that the future of FMC is bright. So maybe what we're seeing here, and I'm going to write this down because I need to do some more due diligence on that. This could be a true value stock. If the market has it wrong, then it would be a stock that is undervalued. But I just don't know enough about it. So it looks enticing to me, Billy, and I am glad you brought that up because I want to do some more diligence on that. And hopefully I'll let you know something here before too long. Now let's see where I am. So that was great, man. I appreciate you bringing that up. It looks enticing. I mean, it's a $110 stock trading for $63, but there's got to be a reason. And we see the earnings going down, but I'm not sure what's driving that huge earnings decline. That would be something I would want to know ahead of that. Okay, I have Joe. Welcome, Joe. Welcome to the house. Want to buy at a lower valuation. I think you're talking about maybe Hershey's, or I'm not sure. Let me know, Joe, which stock that you want it to go down a little bit more. So there's a lot of them that I want to go down. BRKB put away for 5 years. Thank me later. Yeah, Mike, you may be right. That's Berkshire Hathaway, the B shares. So you may be right on that. But, we'll just have to see. Philip, I normally miss your live streams due to work. I do watch them later. That's fantastic, man. And I really do appreciate the comments. I know you sent me some comments and questions and stuff. And for everybody, I really appreciate those. One of the reasons I do this is to connect with all of you. I mean, I enjoy the interaction. And for me, this is not about YouTube. It's about investing. And so I'd like to have this consortium of people who are working together, trying to get the best investment portfolio that we can. So by building these relationships online, I think it's only a good thing. And I'm really glad to have you a part of that, my friend. So we have Christian Reisner, is that the way you say it, in the house? Can we take a look at Organon and Company, OGM? It's a pharma company. Absolutely. Let's let me do this. So let's look at OGN. We will look at my favorite first go is simply safe. So they are rated unsafe at 40. They've got a dividend yield of 7.73. So again, that's an enticing yield. And so the question is, why is that? Let's go take a look at what's. So they have only been paying dividends for a couple of years. Actually, it says for 1 year, but it looks like 2 to me. And then they've been growing it. But some of this data is not making sense. Looks like they've got 28 cents per year for 21, 22, and 23. Maybe they're paying special dividends. No, evidently not. Their PE ratio is 3.4, so they're in the same boat as one that we looked at earlier. I forget who that was. That was 3.4. Their earnings payout ratio is pretty good. It's below 30%. Their free cash flow payout ratio is looking pretty decent. Their sales are declining. You can see their sales here went from 10.5 billion in 2017, and they're forecasting 6.15 billion. So they're down by a good 40%. The return on invested capital is dropping like a rock. They were at 52% back in 19. They're now down to 16%. They're looks like they and their earned interest coverage ratio is 2.5. So I think from my perspective, I'm not sure if I need to look at too much more here, but let's take a look just at Morningstar. We'll look at OGN on Morningstar. And they're not covered by Morningstar, so it's not. We don't need to look at that. But I would, from my perspective, Organon. Sorry about that. Organon looks like it's got some problems. Its share price is down significantly, evidently, and it looks like there's a reason for that. So I would say that I wouldn't be sucked in by that 7.7% dividend. And I would want to know more about that business. I would want to understand about its drug pipeline, if they've got drugs that are going into the generic category, and just what's going on with them. So I would be a little leery of Organon personally, but hopefully that helps. And that's just my thoughts. That's my opinion on that. All right, we got Kevin Mendoza asking us, what are your thoughts on BDX stock? He has it on his watch list. Well, let's see. Let me pull it up because I don't, it's off the top of my head. I'm not tracking with BDX. Hopefully the name will mean something. Becton Dickinson and Company. I think I've looked at this before. It's a healthcare company. It's a 1.56% dividend yield, 91, very safe dividend score. I like that. You can see that their growth in dividends has gone up dramatically. Let's take a look here. I mean, everything from a dividend perspective looks good. Look at their payout ratios are phenomenal. Earnings per share has been kind of flat, but at least it's very positive. Their sales are up and to the right, so that's good to see. Return on invested capital is about 6%. That's not a deal breaker. Their debt's at a decent level, and their interest coverage is a little bit low, but again, that's not terrible either. So let's take a look then at their BDX. Let's look at what they're valued. According to Morningstar, they're valued at $325. So they are undervalued in Morningstar's opinion. And, it looks pretty decent to me. I like the dividend safety. And, I would want to see what it's, rather than wanting to see it, why don't we take a look at fast graphs and take a look at what its forecast is for earnings anyway. Well, its earnings are going up. Yeah, I don't know. That's certainly worth looking at, Kevin. I think it's. I would certainly agree with you about it being on the watch list. I'm going to make a note of that one as well, because part of this is about me doing some research, right? So that's good. I like BDX. based on what I saw here. All right, let's see. Christian, Merry Christmas. Can we take a look at Pfizer? We can take a look at Pfizer. Maybe I should just leave this up. So we'll do PFE. Since we're all having fun here, PFE. Wow, Pfizer, the earnings are dropping off a cliff. Look at that. And that's why its stock price is down. It does forecast again going back up, but again, which company does not forecast positive earnings moving forward? So I would say the stock price decline in Pfizer is a reaction to the actual business declining. So that would be my reaction off the cuff. Let's see what PFE looks like in here. I didn't realize their business had fallen off like that. So their dividend is safe at 75, according to Simply Safe Dividend. They've got a nice yield at 5.8%. The payout ratios, wow, they're going to go to 112% in the next 12 months. And look at their free cash flow payout ratio. See that? That's 112%. They're saying next year is going to be 58%. That's not terrible. I would want to understand if that's a one-time thing or if that's something that's going to continue. So yeah, I mean, Pfizer makes me a little bit nervous, but wow, look at the return on invested capital drop from 29% to 5%. So yeah, there's a lot of questions I would have. Their interest coverage ratio is also 4. So it looks like they're dropping in price, but it seems like it's a rational drop to me. I would want it to drop even further to be a valuable pickup. That's me. That's the way I would look at it. So, but again, that's why you're paying to watch this. Oh, wait, you're not paying. That's why you're watching this broadcast for free. It's because you want to know what I think about it, right? So here we go. Thoughts on FIS. I'm trying to think of what that is. I sold a put on this in August for 700 with a strike of 62. It was at 50. Stock now at 60. Put worth 225 a day. I like the stock long term. Do I take assignment? Let's see. FIS. That's a good question. All right, let's go to Simply Safe here. Of Fidelity National. That's it says transaction and payment processing services. I'm not sure. I have not researched this company. So let's just take a look. We've got a dividend safety score of 77, and it's a yield of 3.42%. The annual dividends are continuing to rise. That's a good sign. It says they have a 2-year growth streak. Must be that this from 19 to 20 looks like it was flat. So I think maybe we give them a pass on that because it was COVID. I'm not sure. But they have been steadily increasing it since then. The yield is 173% above its 5-year average. And the PE ratio is about even with its 5-year average. So that is kind of telling. What does that tell me? That tells me that their yield that means that their dividend payout is increasing faster than their share price is increasing, which means it may be undervalued. Earnings payout ratio is jumping. The free cash flow is actually dropping. Free cash flow payout ratio is dropping. Their sales are growing up and to the right, so that's good to see. Return on invested capital is nothing to write home about. I think long-term, they might struggle as a company from a long-term perspective because of that. Their interest coverage is low as well. Let's see where they're valued to see if it's worthwhile. FIS. I will, let you guys know this, that every stock is worth buying at some price unless it's going bankrupt. So, the question is, what price is that worth buying at. So it's saying the fair value is 76. It's currently around 60. Um, I think from my perspective, so going back to Chris here, he's got he sold a put, which basically means that he has given someone the right to sell him shares at $62. So he is looking to buy these shares at $62, and it's worth $225 today. So it looks like you could buy that put back for $225, have a gain of $475 on the put, and still buy shares at $60.80. I mean, Chris, if it were me, I think I would buy that put back. And if you like the shares, I would buy them at $60.80 versus keeping the 225. Depends on, well, it's 100 shares. So what is that? 100 and, well, it's, sorry guys, I was going through some gymnastics in my mind here. And I would say it's 6 in one and a half dozen in the other, because if you buy this back at 225 and then buy 100 shares at 60.8, it's $120. So the difference is about $100. So maybe you would keep it and let it get assigned, and you would save $100 in the deal. But if the shares go down another dollar a share, I think it's 6 in one, half dozen in the other with what you do. That would be my opinion. I think I would wait and let the assignment happen at this point. But if the share prices continue to go down, of course the put price will change as well. But I mean, I think you're kind of locked in. So I don't think it matters personally whether you buy the premium back today and buy the shares, or just let the shares get assigned. I think it's about the same deal for you either way. Those are my thoughts. And you say, or buy it back and sell another. I mean, that's certainly a possibility, because you got the gain on what you currently have. So that could be worthwhile. Okay. Now I'm going to try to pronounce this. Yamomanem. I'm close, I think. Yamomanem Jazz. Just so you guys know, he sent me a message and said that he canceled the date just so he could be here with us tonight. So we have Coke and Pepsi. Yeah, you sent me that in a message, and I forgot to get back with you on that. So let's take a look. We'll do a fast graphs really fast. We'll do a fast graphs on Coke, which is here, Coca-Cola. And it's pretty pricey. It's 21.9 PE ratio, but it's and then let's take a look at Pepsi. Do PEP. Pepsi's also well above the mark here at a 22.4 PE ratio. So I would say they're both relatively pricey from my perspective. But I will say this: I bought Pepsi, back in here somewhere, and then I ended up selling it, up in here. But I will tell you, at the time I sold it, I was like, I don't know why I owned it to start with, and I don't know why it grew so fast and so much. But I was happy that it did, and I'm now happy to be out of it. It looks like it has dropped in value, so down in the 160s. So pretty happy with the position I took out on Pepsi. But I'm not interested in either Pepsi or Coke at these valuations. That's my personal opinion. And Chris, yeah, the expiration is coming up, so it's within the next 3 weeks for sure. So yeah, good luck with that. Let me know how what you end up doing. That sounds like a fun thing. Jim, he's going to hit the rewind button in about 15 minutes. So welcome to the broadcast, my friend. Let's see, stock not talked about is AGM. I have owned since 2008. Take a look sometime if you get a chance. So let's just take a look really quick at AGM. We'll do a fast graphs on it. AGM. Federal Agriculture Mortgage Corp. Never heard of it. It looks like it's undervalued. According to fast graphs. I said I would just do the fast graphs, but I'm intrigued now. So it's got a 41 borderline safe dividend, and the yield is 2.28%. It seems to be growing it pretty quickly. Look at this, 20% per year. So that's a pretty fast growth rate. There's obviously a reason. I mean, those look fine. The payout ratios look good. The sales are going up and to the right. They don't have a return on invested capital. I'm not sure why that is. Oh, they've got net debt. They've only got 5% equity. 95% of their cap structure is debt. I would want to understand that. I mean, how do you have a 95% debt structure? That doesn't bode well for shareholders. So that may be why this has a borderline safe dividend rating. So, I mean, those are my thoughts. That's the first time I ever looked at it, David. So, maybe I'm missing something, but those are my initial thoughts on it. FMC is down because natural gas, maybe fertilizer stocks suck until they don't. FMC shot up when gas did last time. Just guessing. Yeah, that could be it. I'm not really sure. John Jay says the inventory destocking affected FMC Corp, and so that's good to know. That's I've got that on my list. I'm definitely going to be looking into FMC. It looked intriguing to me. Kevin Rayberg is in the house. Welcome, my friend. Billy, yeah, great reminder, Billy. I appreciate that. Everybody hit the like button. We have gone up above 40 viewers tonight, which is phenomenal. And I just looked, and we're at an hour and 6 minutes. So I am taking all of your valuable time here. So I'm going to fast forward here a little bit. Philip, you're a great teacher. What is the best thing about retirement? I appreciate that, and because I do enjoy that thing. I'm not a teacher, but I do enjoy teaching. And so the best thing about retirement, and I've said this before, but the best thing about retirement is being able to do what I want when I want it. It's not that I don't do anything. You guys know that I have a farm here in Alabama. I, for the first time this year, have raised chickens and gotten eggs from chickens, and I have bees for the first time ever. There's just a lot of things that I've done for the first time this year, but it's things that I want to do, and so there's a lot of joy and a lot of fulfillment in doing that kind of thing. So if you're looking at retirement, I wouldn't think of retirement as not doing anything. I would think of it as doing what you want when you want and getting a lot of fulfillment out of the rest of your days. So that's the way I kind of look at it. But I appreciate you, my friend. I'm glad you're here. Let's see. I'm going to hit just a couple of these. Let's see. This is an interesting question. How often do you review your holdings? Monthly, quarterly? I think it depends on what you mean by review. I look at the markets every day that they're open. And so, that's one thing that I do. But I think you may be talking about how often do I look at my investments. And I try to look at them on a quarterly basis when their earnings come out. Anytime that there is a news flash, I will, look at that news flash and see if I think it impacts anything. But I try to listen to every earnings call, and I will typically take notes on those earnings calls so that I can go back quickly and kind of assess what's going on. So I would say quarterly. I don't review every holding I have on a monthly basis. There's just too many. And it's difficult even on a quarterly basis to look at 32 individual companies. That's why I'm trying to skinny that down a little bit. I'd love to get it down around 25 or so. So hopefully that helps. Let's see. So I'm going to kind of skip down here. But you guys are awesome. I am so glad. Um, Jim, Jim, I think's got it really better than he's articulated it much better than I did, and that is that retirement is doing what your wife wants when your wife wants it, and I think I think you're pretty much right, my friends. uh, so hey, this is a good idea. Kenji says you should do a live earnings report. Maybe that's not a bad thought. I will look at that, and maybe that might be our next one. Well, yeah, I tell you what, I'm going to do this weekend though. The video coming out this weekend, I think is going to be really important, and that is it's going to be a year-end review, not a year-end review, a year-end review. A year-end review would take a long time, but a year end review of my portfolio. What was the performance of the portfolio? How do I measure that? How what am I looking to do in the next year? Are there any changes that I'm going to make? um, and I think that'll be kind of interesting for you guys to see what it is that I do with my portfolio, how I analyze it. Doesn't mean it's perfect, but it either gives you guys a perspective on maybe how to do it, or maybe more importantly how not to do it. But either way, it's helpful for you guys. So that's what this weekend's video is going to be about. It's going to be a lot of fun to make. I've already started putting the slides together for it. So, but I do have to wait for tomorrow because I can't tell you what the returns are until after I get the year done. So we'll kind of make that video on Saturday. And this is the last one, my friends. In Alabama and the rest of the South, all soft drinks are called Cokes. Want a Coke? Yes. What kind? Pepsi. I think you're exactly right, Michael. When I was growing up, I grew up in the South, and as I was growing up, you would go to the restaurant and they would say, "What do you want to drink?" And you would say, "I want a Coke," and they'll say, "What kind?" You'll say, "Orange soda." So it's just a cultural thing. I don't know why it is, but it is true. It's absolutely right. I think it's getting better, but it certainly when I was growing up as a kid, that's exactly the way it was. So guys, man, I appreciate you being here. I think this has been a great live stream. So look forward to the video this weekend. And then I may move the date again because Monday night, I think there's maybe a big football game on. I'll look at the football schedule for next week and try to pick the best day when I'm not interfering with some kind of college football, masterpiece or something. So look forward to that, and I'll let you know what the date will be once I look at the calendar for next week. And other than that, I will see you on the next video, and I appreciate you guys being here. Take care, everybody.